Have you ever wondered if it's possible to earn money by trading something based on luck, like flipping a coin? Hello traders, I'm Panos, and in today's video we will explore the likelihood of winning trades even if your strategy is purely based on luck. In other words, the strategy will be based in luck, but execution and risk management will have a strict structure to follow. If you have been trading for a while, you probably have heard how important risk management is, and many traders will go as far as suggest that if you would flip a coin, as long as you have a good risk to reward ratio with a relative solid win rate, you would still be profitable. Well, this is exactly what we will examine today. I know it sounds counterintuitive since according to most brokers' disclaimers, 90% of the traders lose. How can it be something so simple and mindless in execution based purely in luck can work? Well, before we dive into the backtest process, first let's take a look on this table. Here you can see the correlation between win rate and risk to reward. For example, if your risk to reward is 1:1, it means that if you risk 1% of your account to profit 1%, you will need 50% win rate to be break-even, meaning that if you win half of the times, your account will be exactly where it started, without of course taking into consideration commissions and spreads. So anything above 50% as a win rate, you will be profitable. In today's experiment, we will backtest 100 trades in EUR/USD 4-hour time frame. The strategy is simple and straightforward. We will flip a coin, and if it lands heads, we will enter a buy. If it tails, we will enter a sell. We will risk $100 for each trade, and we will aim to take profit at $200, meaning that risk to reward is 1:2. If you recall the table, we only need a 33% win rate to get break even. Now, the tricky part for this strategy is the stop loss. Since the strategy is not based in any sort of candle structure, I will use an indicator called average to range. You can find it in 3D view by clicking the indicators button, and in the search bar, if you press ATR or average to range, it will pop up above. If you click it, then on the bottom of the window, it will come this line, which is the average to rate indicator. For those that don't know what this indicator does, it measures the volatility or the amount of price movement in a financial market. It helps traders determine the potential rates of price fluctuations over a specific period of time. Put it in simple words, it calculates by default the 14 last candles, how much they have fluctuated in pips, and it gives you an average pip count. So, for example, on this 4-hour candle, if you see on the bottom left, it has been the ATR or average to range, it has been like 22.7 pips. So which means if we enter a trade here, the stop loss would be 22.7 and then take profit would be double that amount. So in every trade, we will use one ATR, whatever that count is at that case, as a stop loss and twice that amount as a take profit. The tools we are going to use for this video's backtesting will be TradingView, where we're going to use the replay button for the backtest and the ATR indicator for the risk management, Google Sheets to journal all 100 trades and analyze the results later, and of course we need a coin to flip, or in our case we will flip the coin online via website so you can see the results on the bottom left of the screen. As we mentioned already, the risk to reward is 1:2, and once we enter a trade, it will either hit take profit or stop loss. And once either of these happen, we will move to the next one. I will now finish the backtest process and I will get back with the result. I'll be honest, I did the backtest recording without knowing what to expect, and even I was surprised by the results. I was expecting to be in the positive side, but under no circumstances I expected to have these returns in such a short period. As you can see, on a total of 100 trades, we had 44 wins and 56 losses, coming to a 43.5% win rate, which is above the minimum of 33% required for the break-even according to our risk management strategy. What's more impressive, the drawdown wasn't bad either, with a max absolute of $600. Overall, this backtesting period produced a whopping 32% gross returns in only 125 days, or about 4 months and 5 days. Another key point is that we were risking a fixed amount of money, and the take profit was also fixed for simplicity reasons, which means had I risked percentages instead of fixed amount, compound effect would have taken over and the results would be quite different. I guess the only thing it remains now is to test it for yourself and see what you got as a result. If you do, comment below your results because I'm very interested to see your findings. Now, understand that under no circumstances I suggest you should trade like this. This experiment was only a confirmation to how important two other factors in trading are psychology and risk management. If you enjoyed today's video, leave a like and consider subscribing to the channel for more backtesting various trading strategies and, of course, relevant financial experiments I'm currently conducting. Thank you very much for watching, and I will see you to the next one.